America's luxury housing fantasy is going up in flames. The million-dollar estates that once symbolized status and success have become gleaming mausoleums of lost wealth. All across the country, mansions with infinity pools, rooftop terraces, and marble-drenched kitchens are being discounted by hundreds of thousands, in some cases, millions. The rich are quietly retreating. Buyers have disappeared. And sellers? They're watching their so-called forever investments bleed value in real time. This isn't a cooling market. It's a meltdown, a luxury implosion happening in plain sight. Tonight, we're counting down the 10 U.S. cities where high-end homes are collapsing in value faster than anyone believed possible. Number 10. San Antonio, Texas. Once seen as Austin's affordable, quieter sibling, San Antonio is now ground zero for a luxury market unraveling at breakneck speed. What used to be million-dollar dream homes, sprawling ranch-style estates with stone exteriors, Spanish-inspired courtyards, and backyard space double the size of anything in LA, are now losing value faster than anyone expected. In 2025, these same properties are seeing 12 to 20% price cuts, according to MLS data. That's $120,000 to $200,000 in vanished equity, often in just a few months. The surge in supply hasn't helped. Luxury inventory has more than doubled since 2022, flooding the market and shattering seller leverage. Homes that used to attract offers within 2 weeks are now sitting stale for 90 to 120 days, and even then, buyers are demanding extras. We're talking $50,000 credits, full-blown mortgage rate buydowns, even free pool upgrades just to seal a deal. The days of bidding wars? Gone. What's left is a buyer's playground filled with concession-heavy negotiations. But the deeper issue isn't just supply, it's income. With median household earnings around $65,000, San Antonio locals simply can't support a luxury tier. During the pandemic, that wasn't a problem. Out-of-state buyers, especially from California, flooded in with cash and tech salaries. Now, that stream has slowed to a trickle. Mortgage rates north of 7%, combined with a cooling tech sector, have left the high-end market stranded, surrounded by neighborhoods anchored in $300,000 homes. That disconnect is toxic, and it's dragging entire subdivisions down with it. Open houses sit empty, price cuts hit like clockwork. And block by block, the illusion of bulletproof luxury is crumbling. If interest rates don't drop, and fast, San Antonio's upscale housing market could see another 25% plunge in the coming year. A city once hailed for offering Texas-sized luxury at a discount is now on the verge of becoming the state's most sobering real estate cautionary tale. Number 9. Miami, Florida. Once hailed as the shimmering crown jewel of American luxury real estate, Miami is now buckling beneath the weight of its own legend. In 2021, million-dollar condos were flying off the market in just 48 hours. Today, those same listings are sitting untouched for 120 days or more, losing value week after week. According to Redfin, nearly 40% of Miami's luxury listings, those over $1 million, have already slashed their prices, often by $250,000 to $500,000 just to stay competitive. Yes, $500,000. Gone, just to keep a buyer on the hook. That's the brutal new normal in Miami. The oversupply is staggering. Developers kept cranking out glass towers and oceanfront mansions, assuming the demand from New York, California, and international buyers would never stop. But it has. Foreign interest is cooling fast. Capital controls have tightened overseas, and a strong US dollar has made American real estate significantly more expensive for international buyers. And then there's insurance, the silent killer. Some high-end homeowners are now paying $20,000 to $30,000 a year just for hurricane coverage. That's not a luxury tax, that's a deal breaker. Even the ultra-wealthy are pulling the plug. Hedge fund execs, crypto millionaires, and high-flying investors who bought at the top in 2021 are now trying to offload properties, often at a loss. In neighborhoods like Coral Gables and Coconut Grove, homes that once peaked at $1.5 million are being relisted closer to $1.2 million, and still, no offers. That's a 20% loss, sometimes more, with no floor in sight. But perhaps the most dangerous ripple effect? Property taxes. Because Miami leaned so heavily on inflated luxury valuations, homeowners are now stuck with sky-high tax bills, even as their home values continue to plunge. This city that once branded itself as a global playground for the rich is now becoming ground zero for the collapse of America's luxury market. Miami proves just how fast untouchable can turn into underwater. Want to know the next city about to make headlines? Subscribe to World Discovery Canvas. We're uncovering the story the mainstream won't touch. Number 8. Atlanta, Georgia. Atlanta was once hailed as the South's unstoppable luxury engine, fueled by booming tech jobs, Hollywood film sets, and the presence of major Fortune 500 companies. During the buying frenzy, million-dollar homes in Buckhead or Midtown could barely stay listed for a weekend before they were snatched up. But by mid-2025, that shine is starting to fade, and fast. Back in 2020, the city had fewer than 1,000 homes priced above $1 million. But speculative building and a flood of pandemic relocators tripled that number, ballooning inventory to over 3,500 luxury listings by 2024. Now, the market is suffocating under its own weight. Prices have already fallen 10 to 15%, wiping out an average of $150,000 in paper equity per property. Time on market has stretched dramatically. Where a luxury listing once went under contract in just 21 days, it now sits for 85 to 100 days, with sellers practically begging for offers. And they're not just dropping prices, they're throwing in incentives. Real estate agents report deals where sellers are including $30,000 in renovations or accepting offers $200,000 below asking, just to keep the sale from collapsing. But the deeper issue: income mismatch. With Atlanta's median household income hovering around $75,000, locals simply can't sustain million-dollar demand. During the pandemic, that gap was papered over by out-of-state buyers, especially Californians looking to stretch their dollars. But with mortgage rates above 7%, that stream of cash-rich relocators has frozen solid. Even Buckhead, once considered immune, is taking heavy losses. Homes that hit the market at $1.8 million in 2022 are now struggling to attract interest at $1.4 million, a staggering $400,000 drop in value. Now, layer in rising property taxes and ongoing concerns about urban crime, and Atlanta's luxury reputation starts to crumble. What was once marketed as a Southern success story is beginning to look like a high-end housing bubble deflating in slow motion. And if Atlanta can unravel this fast, it's a clear warning: no boomtown is bulletproof. Number 7. Portland, Oregon. Portland's luxury scene was never mainstream. It carved its own niche: sleek eco-modern mansions, glass-walled cubes tucked into the West Hills, and lovingly restored heritage homes in the Pearl District. But in 2025, that charm has curdled into collapse. Million-dollar properties across Portland are now seeing value drops of 15 to 25%, erasing $200,000 to $400,000 in equity, all in under 2 years. Back in 2021, high-end listings would vanish in just 12 days. Now, those same homes sit untouched for 90 to 150 days, often after multiple rounds of price cuts. Nearly 40% of luxury listings are showing reductions, and in some cases, sellers are shaving off $500,000 or more just to stay in the game. Buyers smell weakness, and lowball offers have become the norm. So what happened? Much of the collapse traces back to Portland's pandemic glow-up. The city was marketed as a haven for remote workers, offering space, sustainability, and a curated lifestyle brand. But that buzz has faded. Population growth has stalled. Incomes are stuck around $80,000, and locals just can't support million-dollar mortgages, especially not in a high-cost, high-regulation market like this one. And the costs of ownership here are no joke. Portland's strict climate codes and zoning regulations mean luxury owners are constantly shelling out for upgrades: solar panels, energy retrofits, green certifications. HOA fees in some communities are now pushing $20,000 per year, before you even factor in insurance. Now throw in 7% interest rates, and those dream homes have turned into money pits. For many, the numbers are crushing. That $1.2 million home purchased in 2021? It might now be worth closer to $950,000, while the owners are still stuck paying inflated taxes and premiums based on its peak value. What was once branded as progressive, sustainable luxury is proving to be financially unsustainable. Portland reminds us that even the most idealistic markets aren't immune. When the numbers stop working, the dream becomes the downfall. Subscribe to World Discovery Canvas because this wave of collapse is spreading, and it's happening faster than most people are willing to admit. Number 6. Sacramento, California. Once known as the affordable escape from San Francisco's sky-high prices, Sacramento was never meant to be a luxury hotspot. But between 2019 and 2022, that changed, and fast. In 2019, just 6% of home sales topped $1 million. But by 2022, that number had jumped to nearly 20%, driven by a flood of Bay Area transplants flush with tech salaries and stock options. Now, that dream has flipped into a nightmare. Sacramento's luxury listings are sinking. According to recent MLS data, high-end homes have dropped 12 to 18% in value, meaning that $1.2 million home bought in 2021 is now worth closer to $1 million, or less. That's up to $200,000 in lost equity in just 2 years. And it's not just the prices, it's the pace. During the buying frenzy, million-dollar homes here were selling in under 2 weeks. Now, they're sitting on the market for 95 days or longer, with nearly a third still unsold after 4 months. Sellers are bleeding, offering everything from $50,000 renovation credits to mortgage buydowns just to keep the deals from falling apart. But the real issue, affordability math that simply doesn't work. Sacramento's median household income is around $80,000, far below what's needed to sustain luxury home payments. With mortgage rates hovering around 7%, a $1 million loan equals $6,600 per month, before taxes and insurance. Now layer on $12,000 in annual property taxes, plus rising wildfire insurance premiums, and it's no wonder buyers are looking elsewhere. To many, Sacramento luxury isn't aspirational, it's a trap. The safety net, a steady stream of Bay Area buyers, is gone. Tech layoffs, stock declines, and economic uncertainty have dried up that pipeline, leaving Sacramento's pandemic-era luxury surge stranded and overbuilt. In upscale neighborhoods like East Sacramento and Land Park, stale listings now line the streets, quiet reminders that the so-called affordable alternative has priced itself out of reach. And Sacramento's unraveling sends a clear message. Even California's second-tier cities aren't safe from collapse. Number 5. Austin, Texas. Once hailed as the crown jewel of America's post-pandemic boom, Austin was the ultimate success story. A tech-fueled mecca where Tesla, startups, and Silicon Valley transplants turned real estate into a gold rush. Between 2019 and 2022, luxury sales exploded, with million-dollar deals tripling in just 3 years. But fast forward to 2025, and that rocket ship has turned into a freefall. Austin's high-end homes are now facing price declines of 15% to 25%, with once-coveted McMansions listed at $2.5 million now struggling to sell at $1.9 million. A gut-wrenching $600,000 loss in equity. According to Redfin, over 45% of million-dollar listings in Austin have slashed prices, making it the worst-performing luxury market in Texas. And it's not just the price drops. It's the cost of ownership that's crushing buyers. With property tax rates near 2.1%, a $1.5 million home racks up $30,000 per year in taxes, plus $7,000 to $12,000 in insurance, especially after a spike in hail and flood claims. Add in 7% mortgage rates, and the total monthly cost to carry that same home is now nearing $10,000. Even high-income buyers are walking away. Inventory is climbing as once-hyped subdivisions, built at the height of pandemic optimism, now sit unsold and silent. Sellers who used to entertain 20-offer bidding wars are now waiting 120 days for a single lowball offer. And the vibe? It's changed completely. The Californians who once boasted about keeping Austin weird? They're leaving quietly, finally admitting they bought into a hyped-up housing fantasy that peaked too fast and fell even faster. Austin's crash isn't just about market dynamics. It's about mood, overconfidence, overbuilding, overexposure. It was a city that believed it could only go up. And now, it's falling hard. Austin proves the most painful truth in real estate. No boom lasts forever. Subscribe to World Discovery Canvas, where we track every surge and every spiral, so you're never the one left holding the bag. Number 4. Boston, Massachusetts. Boston's high-end housing market was built on the bedrock of stability, anchored by world-class universities, elite hospitals, and a booming finance sector. For years, it felt untouchable. But in 2025, even this stronghold is starting to crack. Back in 2019, around 30% of homes in Boston were valued over $1 million. By 2022, that number had surged past 45%, driven by fierce demand in areas like Back Bay and Beacon Hill. Now, that surge has reversed. Hard. Luxury listings across the city are down 10 to 15% from their peaks. A $1.3 million brownstone is now fetching closer to $1.1 million. At the top end, penthouses once asking $4 million have slid below $3.2 million, an $800,000 haircut in under 2 years. And the culprit? Affordability, plain and brutal. Boston's median household income hovers around $95,000. But take out a $1 million mortgage at 7%, and you're looking at nearly $7,000 a month, before taxes, before insurance. Now add in $11,000 in property taxes and HOA fees that can reach $2,000 a month, and even high earners start doing the math and walking away. In fact, renting luxury apartments has suddenly become the smarter financial choice, draining the buyer pool for ownership. Time on market has exploded. In 2021, a $1 million listing might last 14 days. Today, they sit for 75 to 100 days, with 1 in 3 properties taking 6-figure price cuts before landing a buyer. And behind the scenes, agents are whispering about ghost towers, sleek new condo buildings downtown, quietly sitting half-empty as developers and investors back away from the market. Boston, once considered recession-resistant, is now a warning shot. No city, no matter how safe, is immune to the pressure of affordability. Boston's luxury slide reveals just how fragile even the strongest markets can be. Number 3. Denver, Colorado. For a while, Denver sold itself as America's next luxury frontier, where mountain views met tech paychecks and a rugged outdoor lifestyle collided with high-end living. Between 2020 and 2022, million-dollar listings exploded, jumping from fewer than 1,500 to over 6,000 properties. But that wave has now turned into a flood, and the market is drowning in oversupply. Luxury home values in Denver have dropped between 12% and 20% since their peak, wiping out $200,000 to $400,000 in equity. In Cherry Creek, a home once priced at $1.8 million now struggles to sell at $1.4 million. Downtown condos are faring even worse, $200,000 to $300,000 price cuts just to get someone in the door. Buyers who used to race in with bidding wars? Now they're sitting back, calculators in hand, dissecting the monthly costs before even booking a showing. And those costs? They're staggering. A $1.2 million mortgage at 7% interest means nearly $8,000 a month, before taxes, before insurance. Then add in wildfire and hailstorm risk, and suddenly insurance premiums balloon to $10,000 to $15,000 a year. For many, that dream home starts to look more like a financial riddle that just doesn't add up. The truth is, pandemic-era overbuilding left Denver bloated, with glass-box condos and modern townhomes that developers rush to market. Now, many of those buildings sit half-empty, with leasing banners flapping sadly in the wind. Even once scorching neighborhoods like Lehigh and Park Hill, where homes drew 12 offers in 2021, have gone eerily quiet. Now those same listings sit untouched for months, and the silence is deafening. The verdict is clear. Denver's luxury surge wasn't driven by fundamentals. It was built on hype and hope. And now that reality is setting in, the illusion is falling apart. Denver's unraveling is a sharp reminder of how quickly a hot market can go cold, and how fragile the high-end dream really is. Subscribe to World Discovery Canvas, because when luxury falls, it doesn't just collapse quietly, it echoes across the entire country. Number 2. San Francisco, California. San Francisco used to define luxury real estate in America. In this city, even rundown fixers could fetch $1.5 million, while pristine mansions regularly soared past $5 or $6 million. But since 2022, the descent has been brutal. and it's still picking up speed. High-end homes across the city have lost between 15% and 25% in value, with certain neighborhoods hit even harder. That $6 million mansion listed during the frenzy? It now sits quietly at $4.5 million, desperately searching for a buyer, and shedding $1.5 million in equity along the way. Back in 2021, luxury listings flew off the market in just 17 days. Today, those same homes are languishing for 120 days or more, with half undergoing six-figure price cuts just to spark a showing. Affordability isn't strained, it's shattered. A $2 million loan at 7% interest translates to nearly $13,000 a month, and that's before you factor in $20,000 in annual property taxes and skyrocketing HOA fees. Even tech workers earning six figures are backing out. Owning a luxury home in San Francisco is no longer a dream, it's unsustainable math. And the desperation is showing. Developers are throwing everything at the wall. $100,000 credits, waived HOA dues, even luxury cars thrown into the deal. But incentives can't fix the deeper problem: a shrinking buyer base. The Bay Area's population has dropped 6% since 2020, draining the demand that once seemed limitless. Stack on rising crime, remote work hollowing out the city's core, and some of the highest tax burdens in the state, and the picture becomes crystal clear. San Francisco isn't just losing value, it's losing confidence. This city, once the epicenter of tech wealth and housing scarcity, is now a cautionary tale of overvaluation finally colliding with reality. San Francisco proves that no market, no matter how iconic, is invincible. Number 1. New Orleans, Louisiana. New Orleans might not be the first city that comes to mind when you think of million-dollar real estate, but its collapse is one of the most devastating. Why? Because the foundation was never strong to begin with. In 2019, only a few hundred homes in the city broke the $1 million mark. But by 2022, pandemic-era migration doubled that figure, fueled by out-of-state investors chasing charm, culture, and value. Now, in 2025, that market has completely fallen apart. Luxury homes across the city are sitting unsold for 150 days or more, often after brutal price cuts of 20 to 30%. In the Garden District, a mansion once listed at $1.8 million is now languishing at $1.2 million, a staggering $600,000 loss in equity. But it's not just the price drops. The real killer here? Insurance. Premiums have skyrocketed. Some homeowners are now shelling out $30,000 a year just to cover hurricane and flood risks. Stack on $12,000 to $15,000 in property taxes, constant maintenance from humidity, mold, and storm damage. And suddenly, owning $1 million home in New Orleans feels like lighting your money on fire. And here's the brutal truth: locals can't afford it. With median household incomes sitting under $55,000, nearly all of the demand came from out-of-state buyers and investors. But now, they're gone. Climate risk, insurance chaos, banks refusing to write loans in high-risk zones. It's created a chilling effect, turning New Orleans into a city where luxury homes are not just expensive, they're nearly uninsurable. Even the most stunning renovations, historic mansions in Uptown, Creole cottages in the French Quarter, now sit stale on the market, their southern charm no match for the crushing financial reality. The problem? New Orleans' luxury boom never had deep roots. It was speculative, it was fragile, and when the pressure came, it snapped. Today, entire neighborhoods once seen as symbols of Southern elegance are lined with aging for sale signs, faded by sun, rain, and storms, a haunting image of wealth erosion in real time. New Orleans represents the sharpest collapse in the nation because it never had the structure to survive. What began as a fragile dream has now become a broken market. If you want raw, unfiltered truth, this is it. Subscribe to World Discovery Canvas because the cracks in America's housing story are spreading fast, and you deserve to see where they land next. From San Antonio to Miami, Denver to New Orleans, the pattern is clear. Million-dollar homes once seen as bulletproof are now sinking in value, leaving sellers stranded and buyers holding all the cards. This isn't panic. This is process. And process always ends the same way, with prices bending to math. This is World Discovery Canvas. Subscribe now because the next city to collapse might be your own.